Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is November 17 and this is a weekly markets update. Let's have a look at the news of week 46 and see what are the next trends. Urea market and generally nitrogen is waiting eagerly for the result of Indian urea purchase tender that will be finalized on Thursday this week. Middle East producers seem to be sure that they will be able to place enough tons in the tender to keep price from significant deterioration. Last week, a cargo from Qatar was sold at $415 FOB, which marks an increase from the last down in the region. Of course, participation of Chinese tons can change the situation dramatically. But current understanding in the market is that additional export quotas will be somewhere in the range between 400 to 600,000 tons, split for many different producers. Taking into account 2.5 million tons inquiry from India, the tender should be able to digest all those tons without much pressure at suppliers from other regions. Iranian producers are still comfortable in terms of gas supply. It was not yet diverted to households due to high temperatures prevailing. Thus, last week, official FOB sales price level was put at $377, and actual sales took place around that figure. Lord Erdogan announced a tender for 50,000 tons of granule product, and other producers offered lots of different size, mostly for end November, early December shipment. In Southeast Asia, producers from Indonesia, Malaysia, and Brunei sold cargoes at $405 to $10 FOB. Meanwhile, European pre-CBAM purchase fever that broke out in the past 2 weeks cooled down. The window for purchasing before January 1 is quickly closing. Ports are congested with more vessels on the way, and the warehouses are full. So, European buyers slow down purchasing activity, and soon it will come to the end. No sales were registered last week in Egypt or Algeria, and the incredible level of $507 FOB is far away from actual bids. In fact, level higher than 500 CFR is meeting buyers' resistance, and in some markets like Romania, this level is even lower. Elsewhere, the demand was slow. In Brazil, buyers are very cautious, all eyes at India, before making any further purchasing decisions, either for urea or ammonium sulfate. For 10 months of this year, Brazil has imported similar volume in nutrient terms as it did last year. The safrinha season is ongoing, and there is no deficit in the market for sure. The latest offers last week were between $420 to $25 for Middle East and Nigerian product, while Iranian product is on offer at around $410 CFR. There was no activity at all last week. In nitrates market, demand continues to be strong, both for ammonium nitrate and CAN across Europe. Thus, Yara again raised its prices for January delivery by 10 to 15 euros, depending on the market. But this rally is purely CBAM driven, the same as in urea segment. Other markets were on mute last week. In the ammonia market, supply is still tight, and market fails to predict further dynamics. West of Suez, supply from nutrient plants in Trinidad and Gulf Coast ammonia plant in the US hasn't emerged yet. BASF plants in Antwerp and Ludwigshafen are also down. But at the same time, European demand was slow, so CFR price hasn't moved up. In the US, barge prices remained stable last week. Agricultural demand remains high due to favorable weather conditions for application, but supply is mostly drawn from previously prepaid volumes in the storages. Market players expect the demand to remain strong until the end of the year, and then soften until spring application window. East of Suez, prices increased by $10 to $15 because contract netbacks approached spot prices. CFR India surged even more to the range $455 to $500, and offers for December already high and level. In phosphates, price deterioration continued last week across the regions. In India, importers are still cautious, with buying as subsidy level for the next season is still unclear. Meanwhile, CFR price level moved lower than $700 for the first time in months. Some suppliers who previously committed cargoes to Bangladesh and Ethiopia have diverted them to India because of unclarity with tenders in these countries. So, Indian Coromandel International purchased from a trader a 50,000 tons DEP cargo of Chinese origin at $699 CFR that was sold to Bangladesh. Also, same-size Jordanian cargo, previously destined for Ethiopia, was rumored to be sold to India even at lower price, but this was not confirmed. Elsewhere, buying activity was low, affordability was keeping it on mute. No fresh sales were registered in the US or in Brazil. All key FOB benchmarks inched lower last week. Moving to the fundamentals. European natural gas futures fell to below 31 euros per megawatt hour, as steady LNG arrivals and strong Norwegian pipeline flows have eased the seasonal shift, while mild, windy weather kept demand soft. In North Asia, LNG prices also fell as warmer conditions in China curbed consumption, freeing additional cargoes for Europe. European LNG imports climbed to more than 100 million tons in the first 10 months of the year, up by 20% from a year earlier. Meanwhile, wind generation remains strong and forecasts point to continued elevated output. At the same time, new Russian strikes on Ukrainian energy sites raise concerns that Ukraine may rely more heavily on European gas this winter. US natural gas surged to over $4.5 per MMBTU, the highest level since December 22, following a larger than expected storage build reported by the Energy Information Agency. US energy firms injected 45 billion cubic feet into storage for the week ending November 7, bringing total stocks to above the 5-year average. Traders weighed mild short-term weather against strong export demand and forecasts for colder conditions in early December, which could boost heating needs. LNG exports remain robust, supported by European demand. Meanwhile, US gas output hit 109 billion cubic feet in November, a fresh record, supporting ample storage levels. Agricultural commodities futures were mostly in green last week. Wheat futures eased at the end of last week back to the level of $5.27 per bushel, as a surge of new crop supplies from major exporters has outpaced near-term demand. The International Grains Council now pegs the 25-26 global crop at a record 819 million tons, driven by rebounds in the EU and Russia and bigger harvests in the Americas. Those larger outturns, along with above-normal inventories in key exporters, have removed urgency for forward buying. Export flows have accelerated from the Black Sea and from Argentina, where the harvest is advancing, producing competitive FOB offers that undercut earlier levels. Chinese buying has so far been limited, while only small US sales have been reported, all of which reduces an important outlet for US and Southern Hemisphere sellers. Corn futures traded above $4.3 per bushel, nearing June highs, as tightening US supply prospects met unusually strong export demand and pre-USDA positioning. Traders expect the November 14 USDA report to show a smaller US crop and lower yields. Export inspections last week topped about 1.4 million tons, and marketing year shipments exceeded 13.7 million tons, signaling heavy overseas buying. Muted farmer selling in Brazil, firm domestic demand from ethanol and feed, and weather risks that could squeeze next season's second crop have further thinned prompt availability. Robust shipments to buyers such as Mexico, Colombia, and Taiwan, and concentrated long positioning ahead of the report, leave the market exposed to any further cuts to US production or renewed export momentum. Soybean futures rose above $11.2 per bushel, marking their highest level since July 24, as markets anticipated fresh USDA update on global supply and demand. Gains were moderated by the lack of large-scale purchases from China, despite recent modest buying of US farm products following a US-China meeting last month. The White House has said Beijing pledged to purchase 12 million tons by year-end, but traders are still awaiting major soybean deals. Chinese state trader COFCO announced agreements to buy over $10 million of Brazilian soybeans and other agricultural products without mentioning any US purchases. Moving to the shipping industry. The Drewry World Container Index decreased by 5%, marking the first weekly decrease after 4 weeks of continuous increases. Spot rates on the Trans-Pacific route saw a double-digit decrease, with rates from Shanghai to New York falling 15% and rates to Los Angeles dropping 12%. Although carriers were able to briefly sustain rates using general rates increases, that impact proved short-lived, as rates softened due to waning demand, with retailers having already imported their holiday season merchandise. Hence, Drewry anticipates rates will either soften slightly or hold steady this week. Carriers on the Asia-Europe trade route are still trying to push spot rates up before the start of the new annual contract negotiating season. The Baltic Exchange Dry Index hovered at the level similar to previous week. The Capesize market followed a generally softer trajectory for much of the week, with sentiment steadily eroding through the first half before a late improvement offered some stabilization in both basins. The Panamax market lived through another mixed week. Activity in North Atlantic and South America was limited, while in Asia rates firmed mostly on the background of steady mineral demand from Australia. Ultra-Supramax market witnessed strong momentum and busy activity, especially from the US Gulf, as well as across the continent and Mediterranean. In Asia, the market was generally balanced. The Handysize market experienced a largely steady yet mixed week, fluctuating between cautious optimism in the continent, Mediterranean and Atlantics, and mild softness across Asia. To sum up, Urea market is awaiting the outcome of the Indian tender later this week. Middle East producers hold their tons for India and feel comfortable. China is expected to cover only about a quarter of Indian demand. That will not significantly pressure supply from other regions and global price level respectively. Meanwhile, purchasing pre-CBAM fever in Europe is cooling down, and major import demand destruction is expected as of second half of December. Price correction in Northern Africa, that was at significant premium versus other supplying regions, has already started last week. Ammonium sulfate price was still under pressure amid slow global demand. Brazilian buyers are not in a hurry to apply sit-and-watch approach, at least before the Indian tender result. Ammonia price east of Suez inched higher due to contract market catching up with the spot values, while west of Suez further price increase met buyers' resistance. Phosphates price dropped more, but this is not enough to breathe life into the market as affordability remains very low. Natural gas price in Europe kept stable, while in the US increased more due to healthy export demand. Future price for wheat dropped due to forecasted supply pressure, while those for corn and soybeans increased amid anticipated lower harvest in key producing countries and Chinese purchases of the US crops. That should reappear soon. Container shipping rates dropped as container lanes were not able to keep the positive momentum created by general rates increase. Bulk shipping was vivid last week across all segments and in most regions besides Asia. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.